Tastytrade review. Tastytrade updated review 2019 and 2020. David Jaffe with beststockstrategy.com. You can visit beststockstrategy.com, enter in your email address, and receive over $400 of valuable free training. Please leave a comment below and let me know your thoughts on Tastytrade. This video is going to discuss an updated review, and it's also going to provide my thoughts and my opinion. You are welcome to disagree with me. If I was watching this video, I would probably also disagree with me, considering that Tastytrade's content with their data scientists and Tom Sosnoff's experience as a founder of Thinkorswim is substantially better than mine. So even though I worked on Wall Street as an investment banker, even though I am also very successful financially, on a relative basis, I am nowhere near as successful as Tom Sosnoff. So if you want to disregard this, no problem. In any case, this is the first week of August 2019. We saw volatility increase, volatility as measured by the VIX index. Volatility increased from around 12 earlier in the week to around 20 because we saw the Fed only decrease rates by 25 basis points on Wednesday. The market was disappointed. At one time, the market fell, the SPY fell around 50 points. The S&P 500 rather fell 50 points. Then on Thursday, apparently the president tweeted something about China, so then the market fell on Thursday and Friday. This is the exact reason why Tastytrade's methodology does not work, because they tell you to trade small, trade often. And while I definitely agree and am in agreement with trading small, when you trade often, it leaves you open to substantial losses. In this situation where volatility increases from 12 to 20, all of your existing positions are on the short put side are going to be showing you a substantial loss. Even the short call side with the volatility expansion, even though the market might be going in your favorable direction, those positions might also be showing you a loss. As a result, when you trade often, it oftentimes leads to poor discipline, and it also has you lose money. Because what Tastytrade does is they essentially tell you that as long as a company or as long as an underlying stock has high IVR, high liquidity, then you should trade that security. They don't tell you anything about making sure that a stock falls to the low end of its trading range and therefore you should sell a put on it. Instead, they simply scan based upon high IVR, which is implied volatility rank, and then they also want to make sure that the index has, or that the underlying stock has, a substantial amount of open interest and it is extremely liquid. Then they tell you to trade often. In this situation, you are going to lose a substantial amount of money because you are taking a shotgun approach. The most successful investors are disciplined and patient. Tastyworks is not telling you to be patient. What they're telling you is that you should trade as often as you can, so that way you generate as you increase and maximize the amount of fees that Tastyworks generates. And on the opposite end of the spectrum, because you're oftentimes selling the call side, you are selling straddles and strangles, then you are going to have to deal with a massive amount of corrections and adjustments and closing out positions, only to then increase and open up that position at a later time. That's called a roll. The problem with this situation is I have never seen any content from Tastyworks that takes into effect the psychological impact of having a losing position. You should never put on a trade with the expectation that it will have to be managed at a later time. If you want to open a position and then the second that that open order fills, you can open a closing order, have it be a good to cancel for the time in force, and put it for a limit order that's anywhere from 50 to 65% of the premium received. So let's say you collect $1 a premium. If it's a naked option, you can You can submit a buy to close order for 35 cents. That way you keep 65% of the premium. You can leave that open so that it automatically triggers once the option that you sold for $1 decays to around 35 cents of value. If you want to do that, no problem. However, with Tastyworks, they tell you to sell straddles and strangles. And what oftentimes happens is that the call side especially will get challenged, and Tastyworks never has created content that I have seen where it addresses the psychological implication of having a position that is now 2 or 3 standard deviations in the money go against you. For them, it's no problem because, in my opinion, Tom and Tony are trading a minuscule part of their overall wealth while they're creating content and running a company. I don't believe it would even be possible for Tom and Tony to have the majority of their wealth in the market and trade the strategy that they are trading while also simultaneously running a company and creating hours of content every single day. Now, when we have a slow grind higher, which is what essentially has happened from, besides May of 2019, but essentially for all of 2019, I can't believe that anyone who would have all of their wealth in the market and while Tom and Tony are trading and have a large negative delta position, how they can possibly remain impassive while they're losing money. It's just not possible. So essentially what they're telling you to do is not what they are in actuality probably doing. Now again, this is my opinion, but again, I do not believe that these people are giving you advice that they themselves are actually taking. Because if you have a position that is going against you and managing and rolling positions is extremely stressful, then there is no way for regular investors who are working a 9 to 5 or even full-time investors to be able to remain as impassive as Tom and Tony are while they're creating hours of content every single day. As I've said, when you trade often, in my opinion, this equals a lack of discipline and a really easy way to lose money. When you sell calls, you are effectively trading pennies for theta decay for dollars. Let me repeat this. When you are selling calls, at least how the market's been over the past 10 years, you are picking up pennies in theta decay and you are trading it, or rather you're losing dollars. Okay? So let me repeat that. When over the past 10 years, when you are short delta, you are collecting pennies in theta decay and you are losing dollars. As I've said, I wrote a lot of notes here, so I want to make sure that I get through everything. There is no way for them to create content and lose money while being impassive. Okay, think of this example, right? Everyone who sells option premium, we sell insurance and collect premium. By them selling straddles and strangles, and I know that they have a lot of data analysts which tell you that selling calls even in a bull market leads to better results with decreased portfolio volatility than simply being long stock, but I personally do not believe that at all, because I have also made 25 to 35,000 options trades, and I'm also an extremely successful options trader, and I can tell you that from my experience, I would not be making this video if I did not disagree with some of the core tenets that they are telling their viewers to follow. So we make money. The maximum amount of money that we can make by selling option premium, just like when we're an insurance company, is the premium that we receive for selling that policy. When you're selling calls in a bull market, it is essentially like you are selling car insurance and every single car that you're insuring becomes totaled. It's only going to take you a short amount of time for your insurance company to go bankrupt, because the maximum amount of money that you can collect is the premium that you received for that insurance policy. Now, the underlying stock or the underlying car, remember, we are acting like an insurance company, all of those cars are going to become totaled. And that's essentially what happens when you are wrong directionally and you sell calls during a bull market. It's only a matter of time, if you're an insurance company, that if you sell insurance policies on cars that all become totaled, that you are going to go bankrupt. Yet somehow Tastytrade is telling you that they can be wrong directionally for 10 years, but still remain profitable. And they are telling their viewers to have a negative bias by being short delta, and that these people will still make money. It just does not make sense. Think about it logically. We are insurance companies by selling premium. When we sell premium on a car, we do not want that car to become totaled. When you sell calls on an underlying stock and then it goes against you, your underlying position is essentially becoming totaled. You will go bankrupt. It is only a matter of time. So when you short delta, it's like selling car insurance and having every car be totaled. You're going to go bankrupt. So you're probably thinking right now, okay, great, but I don't believe that Tom is bankrupt, so how does he do it? That would be a viable question. You're asking me, if Tom and Tony do not follow their own strategy, then how is it that they do not lose money? And the answer is very simple. They hedge their portfolio in the futures market to straighten and level out the delta. Again, what they're doing is they're collecting theta, which is the time premium decay. They have short delta, and then they are hedging their portfolio by going long what I would assume would be SPX options in the futures market. Therefore, if the market grinds higher, even though they're losing money on those call positions, their futures positions are offsetting the losses of their call options. So is that a decent strategy? I guess it's not that bad. I personally wouldn't recommend it, but the more important aspect is that while they do touch upon this, they don't expressly recommend this to their followers. Instead, the only thing that they recommend to their followers is selling option premium. And by Tom and Tony day trading futures in order to offset the delta risk of their individual portfolio, to me, that is extremely, it provides a lack of clarity, a lack of transparency, and in my opinion, it is also extremely dishonest because they are not following the very tenets of the strategy that they are encouraging all of their followers to trade upon. Additionally, as a lot of their followers have anywhere from like $2,000 to $10,000, you do not have access or the ability to hedge your portfolio with an SPX future. Now, you can, just because I know that there's going to be like 1% of the people watching this video, they're going to say, David, you're wrong, because you can buy, what about if I hedge my portfolio delta risk by buying SPY? Okay, fine, you could do that, but the fact is, why would you want to do that? Why would you want to buy and go long the SPY, which is going to eat up a substantial amount of your buying power, when there's a better strategy available to you that's going to substantially reduce your portfolio volatility, increase your gains, and also reduce your risk? And that's what I teach at beststockstrategy.com. So again, I do not believe that if you follow Tastytrade, you are going to make money. I do not believe it is possible for Tom and Tony, who are telling people to only profit from the option decay, but then they are wrong directionally by keeping a negative delta in their options portfolio. I do not believe, in my opinion, that they are successful and profitable traders. What they are doing, in my opinion, and you can ask them this by emailing them, is they are balancing out the negative delta by increasing and having positive delta in their portfolio in the futures market by buying SPX. Therefore, when the market continues to grind higher, the losses that they're showing in their options positions by selling calls are offset by the gains in their underlying SPX position. The problem with this is that they are being dishonest, because if you have a position that's below, if you have a portfolio that's below $100,000, you cannot hedge your portfolio with SPX positions. And if you have a portfolio with a few $1,000,000 in it, $5 or $10 million, then even someone like myself, I would not want to hedge my portfolio by being long XPX because I do not believe or see the value of day trading or scalping, as Tom always talks about, scalping futures. There is zero benefit when you have a better strategy available to you. Additionally, I think it's extremely convenient for them to tell you that it's important to trade often when they are charging you and they are directly profiting from your trades. The more you trade, the more money they make. Tastyworks charges around 14 to 14.5 cents per every contract that you sell. That means that they are passing on all of the expenses of the exchange fees onto its users. They charge $1 per contract. For them to introduce selling premium, and for them, and I would say on average, a lot of the people that use Tastyworks have account balances below $20,000 or $30,000. Tom talks about this all the time on the show. He always talks about standing up for the little guy and how he doesn't care how much money how if you have a small amount of money, you should not be restricted or you should not have any fewer rights or options, or you shouldn't be treated any differently than someone who has a few $1,000,000 in their account. But from his behavior, it's extremely dishonest because there is no way that you can be short Delta and have an account of $5,000 and trade the Tastyworks way by selling straddles and strangles, and at the same time have the ability to hedge your negative delta from your options by going long futures. That is simply not available to you. Again, I want to repeat that. There is no way that you can sell options and you can sell insurance on cars, have those cars all become totaled, and not go out of business. Now, what Tom does is he will buy additional insurance on his portfolio in the futures market. You, who probably has an account below $20,000 or $30,000, cannot go out and purchase additional portfolio insurance in the futures market. That's why, in my opinion, when you also consider that Tastytrade is owned by Tastyworks and therefore they make and their profitability is directly influenced by having you trade more often, that their exchange fees and their passing on of fees, 14.5 cents per every contract, is the highest that I've seen from any broker. And I also do not believe that they have created a video which addresses the psychological implications of managing positions, and the fact that they also tell you to trade straddles and strangles, and they take a shotgun approach. Now, you're welcome to believe whatever you want. Go look, Tastytrade tells you to trade option premium, it tells you to sell premium. That's exactly what I teach. So is it better than day trading or trading Forex or penny stocks or anything else? Of course it is. But is it optimal? Of course it's not. But if you want to completely disregard everything that I'm telling you, go do it. No problem. I don't care what you do. I am just providing you with my opinion, and I'm telling you that just think about it logically. We make money. The maximum amount of money that we can make is the amount of premium that we receive. The maximum amount of money that we can make is by keeping 100% of the premium. If we sell a car insurance policy and that car becomes totaled, which is exactly similar to what happens when you sell calls during a 10-year bull market and the underlying market continuously goes against you, you are trading, you're collecting pennies and you're paying out dollars. It is only a matter of time before you go bankrupt. The only reason why Tom and Tony are not losing tremendous money by keeping that negative delta in their portfolio is because they hedge their risk in the futures market. They are day trading futures. You, who probably has an account below $30,000, because that's the average investor that they target specifically. They target the little guy. They always talk about the little guy. We've cut fees 80%. We don't believe that anyone with $2,000 should be treated any differently than anyone else with $2 million. You do not have the ability to hedge the delta in your portfolio. Okay? Simple as that. If you want to take a shotgun approach and you just want to place trades based upon high IV and liquidity, be my guest. You are going to find that almost all of your call positions get challenged. You're going to get stressed out. You're going to be more irritable. You are going to give up trading. And most importantly, you are going to sustain losses. If you want to learn a better strategy, go to beststockstrategy.com, enter in your email address. You're welcome to sign up for my trade alerts. You can see how disciplined and patient investors make money, how we optimize our profits, how we minimize our risk, and how we are able to make and maximize our returns while also reducing portfolio volatility. You can go to beststockstrategy.com. It's only $19 for a 7-day trial of our trade alerts. You can compare them. You will see that we are extremely disciplined, extremely patient, and leave a comment below and let me know your thoughts on whether you believe the Tastytrade method and the Tastytrade strategy is the best way to make consistent and profitable returns in the stock market. Thank you very much for your attention.